Welcome to TMS Insights. This is a mid-February edition as we're in the middle of the reporting season. Very busy time for us and the market as a whole. Ben, we've had a lot of reports to digest in the last couple of weeks already, and we know there's a lot in front of us, but maybe we'll start with one that reported a little over a week ago. A very good result, but CSL doesn't always meet the market expectations, and the market reaction initially quite negative.
Yeah, well, I think it's good to talk about because it's been a theme of a number of companies we've since reported, and a lot of prompting client questions. What's going on here? And CSL was a perfect case in point where you looked at the result. The result was very strong. The earnings numbers, the revenue numbers, a very slight sort of touchdown on the full year forecast from the company of sort of 1%, which isn't anything really to worry about. But I think more illustrates that we've a lot of good quality companies. They've run quite hard into this reporting season, and a lot of these stocks are really sort of almost priced for perfection, and only a tiny negative can see quite a decent move in a share price. But as we've seen, with the better quality stocks, it's quickly sort of seized upon as a good opportunity, potentially as an entry point.
And CSL certainly bounced back the following day.
Yep.
But a big fall that day. And it is so much more about the expectations. I mean, share price action on any given day is all about the marginal buyer and seller.
Yep.
And so explanations about what price reaction happens can be, quite spurious in that sense. So we look through that, and obviously opportunities can present. But in CSL, we should be comfortable with what they reported, and the outlook is basically very good.
Great result, I thought. Still a huge pipeline of growth opportunities for the company over the coming 5 to 10 years. They're seeing a little bit more competition in their key markets, and that's putting a bit of margin pressure on. But they've also got multiple potential new markets to open up, and still very much dominating their market as the main sort of player there. So, we still think it's a great business to own.
Yep, good one. Yesterday we heard from car sales, Seek the day before, realestate.com the week before. Great area from share price performance over the last few years, an area we really like. But some interesting themes developing there.
Definitely. And I think one of the themes, particularly with car sales and Seek, has been the companies are having to find new areas of the market or their business to invest back into, to try and continue growing their businesses at the rates we've become accustomed to. Yeah. And that's, if the businesses don't do that, then earnings growth will sort of taper over time. Yeah. And given the high PEs these stocks do trade on, potentially even with consistent earnings growth, the share prices could go sideways as the PE multiple sort of slowly derates to reflect a lower growth outlook. So the most important point I think we both agree when looking at these is who are the guys that are reinvesting the money. And Greg Roebuck at Car Sales and Andrew Bassett at Seek founded these businesses. They've got long-term track records of spending shareholders' money very wisely. And if they believe there's opportunities to spend that money rather than let it drop to the bottom line and be paid out to shareholders as a dividend, to lock in potential huge levels of growth in future years, I think our attitude is, you've got to keep backing those guys to make good decisions.
Yeah, no, I agree. Good results overall. It's interesting. Margin compression can be a negative sign in some ways, and that's certainly a fall in the Seek share price after the result. But if it's to invest into the business and the longer term growth, we see that as a positive, and we're not looking at quarterly or half-yearly numbers alone. We're looking at that longer term outlook, and ultimately the market will too.
Absolutely. And I think if you're looking at those three at the moment, it'd be fair to say in the shorter term, realestate.com maybe has the better sort of prospects in that their market is really charging, and they're coming into a year after a flat year of pricing last year to sort of placate the agents about their new model, potentially quite a bit of growth for them this year. Seek, I think, looks to have an incredible offshore pipeline that they've built over the last decade, and also, of course, reinvesting into the domestic business, which will take some time to pay off. And car sales is probably, there's probably a couple more question marks on that one.
Might have to consolidate before it goes ahead a bit,
Right.
but still looks very good. And
Yep.
again, the market ratings and the PEs and the prices they put on
Reflecting.
it reflected. So
Yep.
watch that one. One that we have watched and it reported yesterday, a new stock to many people and certainly to the market in 2014 was Isentia, code ISD,
Yep.
owner of the Media Monitors business. People might be familiar with that name. Good set of numbers for their initial half-yearly report.
Yep.
And a very interesting company, Ben.
Yeah, look, I think so. It's we classify this as a technology stock, and they provide sort of media intelligence to companies. So 87 of the ASX 100 businesses are clients of Isentia, and they basically provide alerts to companies as to whether they're being discussed in any sort of news publications around the world. And great service to a business who can, it's a necessary sort of alert that they need to get without having to employ a lot of people to monitor it. They're cross-selling a social media sort of platform to those clients, and they're signing up new clients rapidly. So the numbers all look fantastic in the result yesterday.
And what we love is contracted revenue, and that's a really important thing for when we invest in the business. We've got a very good sense of where their earnings might be in a year or two. This has got nice protected earning streams, which we really like. So one to look at. Some big ones that have reported, Ben, Commonwealth Bank and Telstra. Commonwealth Bank, what can you say?
Both look great.
Yeah.
I mean, Commonwealth Bank, we've seen ANZ's just sort of, just slightly touch the brakes on their sort of
their quarterly
full year.
numbers, Asian growth, not as impressive as it had been.
Yep, CBA continues
Great.
to lead the pack in terms of the banks. It's gone ex-dividend this week, of course, a nice fully franked dividend that I'm sure clients continue to appreciate. And Telstra, no real surprises there.
No.
The dividend maybe slightly a little bit behind some analysts were hoping for, but still very attractive.
Yeah.
Share price has been strong, and it goes ex next week, doesn't it?
That's right, it does. So 15 cents, that's good. And maybe it's just a final comment. Yesterday, a massive bid was launched by Japan Post for Toll Holdings. We've seen some buybacks announced. In terms of money coming back into the market, we can now see that probably there's going to be quite a bit at the front half of 2015. Of itself, it's of interest, but how it might impact the market with more cashed up investors, again, another potential positive.
Definitely. And our clients in pension environment will have appreciated, hopefully, what Rio announced earlier this week, which was an off-market buyback, relatively small sort of dollar figure there, but it's still a nice little game for those sort of clients to be able to seize on that opportunity. And I think you're totally right, Jeremy. I mean, in this environment of very low interest rates and a lot of companies trying to find a growth avenue in economies globally that are sort of pretty soft, M&A becomes a much bigger thing. Yeah. It's probably going to be something we're going to see more of as the year transpires, which is ultimately good for the share market.
Yeah.
And also, if you look at the experience in the US, coming out of the GFC, so many companies doing on-market buybacks, etc. And we're starting to see some of those announcements coming through in our market, which also sort of bodes well for future share price growth. So that's a positive.
A confident sign. As we sign off on this session, we'll be back again during the month of February with more half-yearly and full-year updates. But that's all we've got for this edition of TMS Insights.